All right, so let's start. People are still joining in, but let's start the session. First and foremost, very warm welcome to all of you for taking your time out and joining us for today's webinar, which is so warm welcome to all of you, and thanks for joining in today's webinar, which is the next to today's webinar as part of this IIQF deep dive with our experts webinar series. Today's webinar topic, as you all know, the webinar topic is on careers in risk management, and risk management, has become a very important area in finance, particularly for the banking and the investment industry. And this is definitely a very lucrative career opportunity as well. This is a field which is growing, and who better than Ujjwal, who would be our speaker for the day. Ujjwal has been working in risk management for more than a decade, and he has particularly led teams of hundreds of analysts in his risk management assignments. So he has been a very prominent figure in the risk management industry. So just to give a brief background about Ujjwal, Ujjwal has done his FRM, CFA, is an MBA from IIM Calcutta, is an engineer, and he also has done his diploma in securities law. Ujjwal is a techno-functional professional with 17 years of experience, of which close to 11.5 years is across product control, FX, rates, credit, equities, credit risk, Basel II, AIRB, and 3.5 years in automation-led transformation. Is currently working as a GM of one of the top MNC IT company, leading their change management team. He is a problem solver, excellent motivator, which I can vouch for. He has been teaching with us, teaching for us for like almost 15-16 years now. So we have a very long association. He has a wonderful proven track record of leading line product control teams during the course of his career, which will build strong culture of risk and control mindset, forged strong relationship with senior stakeholders across diverse geographies and functions, and led change management while optimizing cost of delivery with various levers. Ujjwal has flair for driving transformation through process automation. So that's about Ujjwal. Thank you so much for joining, Ujjwal. We welcome you to the session and looking forward to your thoughts that you'll be sharing.
Thanks a lot, Nitish. Thanks a lot, everyone. Good morning, all. Good afternoon, all. Yeah.
Right. And before I hand over the session to Ujjwal, brief structure of how we would be going about in the session. So basically on the topic, Ujjwal would be speaking for about 50 minutes or 55 minutes. And then after that, we will go into the Q&A. Before we go into the Q&A, of course, we will briefly introduce all of you about the wonderful work that we have been doing in the quant and the risk management industry for almost 15 years now. And then we'll go into the Q&A. So, please feel free to type in your questions or queries or any particular point that you would like to discuss in the chat window. Unfortunately, since the audience size is quite big, we would not be able to allow you to unmute and speak. But nonetheless, we want the session to be as interactive as possible. So please feel free to type in your questions, and we would be happy to take all that, right? So with that, I will hand over the session to Ujjwal, and then Ujjwal, whenever you are ready, you can start the session.
Absolutely. Thank you very much. Hope I'm audible and visible to everyone. And
yes, absolutely.
Thank you very much, Nitish, for the kind words. It does. So you're able to see my screen now, or
yes.
Are you able to see my screen now?
Yes,
okay.
Yes, we are able to see your screen.
Yeah. Okay, friends. Good morning, everyone. This is Ujjwal. It's very nice to speak to all of you on a reasonably warm Saturday afternoon. And thank you very much for taking out time from your busy days. Well, you could have done something else. So that shows your interest in, and that's one of the biggest points which I wanted to start with. What was the risk of not joining this session? That comes to my mind, right? The first thing that comes to my mind is, okay, why do I have to join this session rather than watching Netflix or probably doing something else or watching a movie? And that starts with one of the first thing is the to mitigate the aspect of missing out on something which might be useful, even though whatever small, however small it might be, right? So risk is, as a topic, is quite it's part of our daily lives, right? What if I don't join this webinar? What if I take a flight rather than or a self drive rather than doing going to public transport, right? There could be risk everywhere in whichever activity we take, or purchase some asset. What if it goes, the value goes down? Or purchase some real estate. What if the land value falls? So it's pretty much everywhere. Now the most important thing is there is an option also of doing nothing. You just don't take risk, right? Then obviously the whole humanity would not have progressed, right? The first, you see a lot of airplanes and now people are sending rockets. The first people to start flying, the Wright brothers, they had a risk of the flight falling off, right? And they had a risk of getting killed. People who went to the moon, they have a risk of getting killed. So it comes in many different dimensions, right? What is that we are trying to do is, naturally we cannot eliminate risk. That's a fundamental. I mean, we could not eliminate COVID also, right? We can only mitigate those situations. So one of the first things that comes to mind when we talk about risk is risk and return, in a sense, go hand in hand. If you do some activity, there is some potential of return. You buy a stock or you buy a bond or you take up some additional activity which is risky, there is some potential of return. I was talking about we cannot eliminate risk, right? For example, with electricity department, we can't control that, but what we can certainly control is what measures we have. With that, one important point which I wanted to just bring out was the overall landscape of risk management. So if you observe, what I'm trying to share here is, again, I don't claim copyright of any of this. This is all from various thought leaders, research papers. But uh, at a broader level, there is an increasing focus towards having an integrated enterprise-wise risk management. So if you observe, there's so much stuff, it's difficult to read, I know, so I'll only cover a few. Basically, the idea is anything that eventually gives rise to some kind of loss. Either it could be financial or non-financial. Non-financial could be your reputation, brand, all of them, which are not immediately financial, but certainly it could lead to financial losses in the meantime, in the future. So classic example is Credit Suisse. There was a lot of dent to the reputation of the bank because of certain accounts which they were not supposed to be taking on, but they took, which kind of hit their credibility. So if you look at it, it's your creativity, what all risks that you are able to come up with, and it's the creativity and it's the diligence of the risk professional to come up with any kind of risk that they could foresee. So it could be operational, third party, health and safety, economic risk, strategic risk, security risk, project risk. There's so much out there, which anything that would mess with your plan, anything that could create uncertainty, and anything that would eventually lead to some kind of financial or non-financial loss, you can consider it as risk. But this is at a more broader level. In fact, some of the research papers I'm putting here, if you observe in the landscape, what are the biggest risk combinations that pose the highest amount of risk, you could see that 23% is business interruption, capital funding. In fact, many of the companies have plans in place to mitigate those kind of risks, or there could be environmental supply chain. For example, I'm not sure if anyone remembers a large container ship was Ever Given, I think. It got stuck in a Suez Canal, and it got stuck for like probably a week or so, and the whole global trade came to a halt because Suez Canal, that small narrow strait, is holding keys apart from the Panama Canal to the entire global trade. So that's a big supply chain risk that we could see, right? Or even the Russia-Ukraine war now, naturally it also has its impacts on many of the food and energy production across the world. So, and of course, cyber attacks. There have been many companies which have been with the interconnected world, where basically each and every one of us are connected, right, on our mobile devices. Our mobile device is basically like an IoT device, right? And essentially, like, for example, Swiggy, Google, YouTube, all of them know what exactly we do, what is our browsing history also at times, which location where we are, if we keep the location on. So it can actually map out everything, and there could be, and as it gets more and more pervasive, you basically also have a risk of cyber attacks. In fact, that is the reason why there is a data protection bill also brought out by the Indian government to ensure that. So there are governments also actively taking the cyber attack risk as important, right? Or it could also do brand damage. Apart from this, if you look at the general industry also, right? So towards the left side, the red button, if you see the different legends, so business interruption, capital funding, cyber attacks, environmental fraud, geopolitics, or if they are broadly the factors, if you see the risk combinations, pretty much it is all related to business interruption related, right? And naturally the top three, the bottom, right bottom, you see business interruption, capital funding, cyber attacks are the top three reasons or issues that we foresee as a risk. This now is at a much more high level, right? So risk is not only in finance industry, but I know our now we will get a bit more into the financial risk management aspect. So there could be enterprise-wide risk, there could be technology risk and all, but what we are focusing later is the financial risk management. But even technology also could pose a threat. With the generative AI coming up, executives were asked, what do you see? Interestingly, optimists is basically those who see this risk as an opportunity. Luckily, majority of them mentioned that, all the C-suite executives mentioned that yes, AI could help us. So it's an opportunity and not necessarily a threat. But we try to do that without understanding what are the limitations and what is the function of generative AI. It is a technology risk in the first place. It is a people risk also, because you're not putting qualified people to run the bots or the programs or the AI machines or the models. And if they do not understand and they continue, that's a people risk, which will translate into a technology risk, which eventually could cause a risk in the process and lead to business risk also. So all of them are interconnected. So, the idea within risk management function is to see what could go wrong. The simple way, it's big words, but a simple answer is just look around, what could go wrong? As simple as that. And what could be my plan A, plan B, plan C, right? That certainly would help. Now, for the financial industry, which we will get into a bit more now, what do you see with this? So you see a regulator pulling up a big elephant, and the person there is a small banks towards the right, and there is a taxpayer in the picture, right? So this is classic case of what happened during the 2009 crisis, wherein usually we know private enterprises, obviously they do profit, they are for profits. If they fail, nobody bothers, which is, yeah, that's your issue. But then it was probably in the first time unheard that, okay, there is a bank, a private company that is failing, but why the taxpayer has to pay? Eventually, it's the government which bailed many of the banks, which is basically the big elephant here, the too big to fail banks. So that was the first time the term was coined. Why? Because the whole idea was, if the banks fail, you would lose the trust in the system. You and me do not trust each other. Right? We might, but I'm just saying, the industry, we all trust ICICI Bank, the SBI banks, and for example, you know that you have, let's say, 50,000 in your account. Eyes closed, you would go to the ATM and expect the money to come out, right? Or okay, even if it is not working, eyes closed, you would expect, if you put a check, you would expect to be paid. But suddenly, if you realize the bank teller saying that, no, sorry, we don't have money to pay you, that's unimaginable for you, right? So this basically breaks the trust in the system, right? And when the trust in the system is broken, the economy runs on the 4 steps, which is savings gets channelized into investments, and those investments hopefully should produce goods and services, productive goods and services like laptops, mobile phones, watches, food, Maggie, everything, which eventually are consumed by people like us. And when we consume anything, we obviously pay. We that also gets someone else to get their salaries also, and that's a cycle we are talking about. So savings to investments to goods and services to consumption, and the consumption in return gives back us the savings through all of us, and at a wider aggregate level of system, which is when in the newspaper, when you see economy is doing well, which means the rate of credit growth is increasing, the loan book is increasing of the banks. Economy is not doing well, the credit growth is dipping. So these are some of the macroeconomic parameters which actually are important. And for them to run this whole show, the people who are helping in channelizing the savings to investments is essentially the banks. It comes from everywhere, both the outflows and outflows. We get paid our salaries in the banks, we pay out from the banks. So ultimately, the banks or the financial institutions are at the center of the whole economy. If they fail, the economy goes for a toss. That is the reason why the government, US government, had probably taken the decision to bail them out, so that the trust in the system is put in. But it comes at a cost. Who pays for that? So it's the taxpayer. So which essentially means eventually your money is being taken out to cover for someone else's mistakes, which is exactly the situation. Again, the cartoon says this is what happened, and that's when eventually there has been quite a lot of aggressive measures taken, a lot of regulations put in, and hence the risk management functions become extremely critical, for the simple reason that we know that we have to do business, but how do we do that? So there are many cases. Lehman Brothers, it's a very old bank, and very famous investment bank, but was eventually, they were of course trading in credit derivatives and products and everything, all paper assets, right? Real estate is called as real because you can see tangible. The plant and machinery is tangible, but financial services industry, it's not tangible. It's all in paper. If you have stocks, bonds, and everything, it's all on paper. Currency is also paper, right? Paper in itself does not have any value, because the paper has the RBI's or the Federal Reserve's signing authority that, okay, I guarantee to pay a promise of this 2,000 rupees. So that is why it has value. The paper itself does not have value. So similarly, financial assets do not have any value themselves, right? Their value is backed up by something else. Now that something else in the case of Lehman was credit derivatives, which unfortunately became worthless, and it was only sold for 750 odd million. That was only because of the real estate. Barings Bank, a 400-year-old British bank, because of fraud, risk-taking, wrong risk-taking strategies, it was sold for a paltry sum of £1. 400-year-old bank gone for a toss. UBS lost 2.3 billion approximately because of rogue trading incident or unauthorized trading. SocGen lost similarly $2 billion because of multiple risks failing, mostly operational and market. Recently, we have Silicon Valley Bank. Again, it had market risk related issues because of which it went bankrupt despite having assets. But now liquidity risk also has come into picture these days, because it's not that you might have a lot of property in your name, but if you don't have cash to eat breakfast, obviously people will not, it's a problem, right? And there are some timelines by which a person will be declared bankrupt if they are not able to meet the liquidity requirements. So there are multiple risks that have come into play. Credit choice, similarly reputational risk, multiple market risk related issues. So all of them are basically saying, and money we are talking about is not a joke, right? UBS wanted to save 1.5 or $2 billion by letting go 15,000 people, but one guy, one rogue trader, one rogue trading incident caused that much of loss. So essentially causing impact for other 15,000 people. So if you see a risk, it's not that it's not my problem, it's everyone's problem, because collectively it will hit us bad, right? It was like a COVID situation also. So if you have someone does not wearing mask and not using the COVID protocols, it's not risk for only that person, it's the risk for people around that person also, right? So that's essentially where the criticality comes in. Now, who are the different types of stakeholders? What are the different types of risks, especially in the financial institutions landscape? So usually we have these different divisions. This is picked up from one of the balance sheets. So you usually see that the divisions are usually organized as personal corporate banking, the usual vehicle loans, housing loans, education loans that we get. Corporate banking, working capital, and other loans that they issue. Or it could be wealth managers, or asset management companies, or it could be investment banks. So if you see, different kind of risks arises from different kind of business activities. So credit risk from lending against any collateral and everything. Credit risk is simply, I have to pay you 1 lakh rupees, I did not pay you, I ran away without paying you. That is credit risk to you. Market risk is you and me got into derivative trade, that hey, rupee will hit so much. If that happens, I'll pay you so much. So market risk refers to risk of loss due to change in market prices. So it could be interest rates, it could be equity, it could be FX, it could be commodities, anything, any market price change. For example, you own a piece of, you want to buy a piece of apartment, for example, it was worth at, let's say, X amount, and suddenly the value decreased after you bought it. It is a market risk. You gave a loan of, let's say, 1 lakh rupees to someone, the person did not pay you back, that is credit risk. So personal and corporate banking heavily, because they are into the business of giving loans, they incur a lot of credit risk. Market risk, they don't trade so much. So if you're not trading much, you're not subject to market risk, right? Even when you are looking at mutual funds, you see towards the end, there's a read of a document carefully, something like that, very fastly said. That is basically they are warning you against market risk, saying that if you are putting your money in Sensex, tomorrow there is a big bad news and the Sensex tanks from 64,000 to 30,000. Then if you had 1 lakh rupees, it will become 50,000 rupees. Likewise. So different divisions have different levels of risk. Simply put, personal corporate banking usually has quite a lot of credit risk, but investment bank typically has a lot more market risk, right? So these are some of the key risks, but non-financial risks also exist, which could be operational, financial crime, compliance, conduct, model, reputational risks. So for example, many of you who, if you are working in a corporate, typically there are many mandatory trainings and courses that you are being asked to do. And if you're not doing it, it is actually a conduct risk, which at least a bank has to report. So that's also a problem, because if the people are not doing the trainings, then that means they are not aware of the content, or they are not bothered about the content. So both ways, it could be looked at both ways, which is viewed as a conduct risk of the individual. So please do all your trainings on time. It's a bit small, but I will just talk about. So these are the different risks. Again, it's a non-exhaustive list, just a what do you call, but does cover many of the risks in the financial industry. So credit risk, risk of loss resulting from failure of a client. So you can see the risk is managed by the business divisions, but independent oversight has to be by the risk management professional, the risk control function, which is where people who are in this function have a big say or a big uh, a role to play in this, right? Market risk, as I just mentioned, risk of loss because of any uh, market movements. Country risk, for example, if you're investing in a country like North Korea or countries which are not so known to be compliant with global standards, so it's a country risk. Sustainability and climate risk, it is becoming completely, it's a very new topic. It is taking up steam, and there are a lot of certifications also that are being of coming up. So the idea is, and I'll talk a little bit about it later also in the slides. So treasury risk is liquidity or funding risk, which is all of them are essentially loss in some or the other way, right? Liquidity risk talks about, okay, I want to sell an asset at some price, but because the market is not so liquid, I'm not able to get the price I want. Funding risk talks about, I have been getting my funding at a certain interest rate, but now because of the market has become tight or bad, I am not getting any funds. So all of this related to the same fact of an impact on your potential financials. Non-financial risks could be compliance. So employment risk, for example, not adhering to applicable employment law or reg requirements, right? Financial crime risk, you do not have any adequate process to tackle money laundering or terrorist financing, which happened to some extent with one of the top banks. Operational risk, which is the risk of failure of people, processes, systems, technology. Any of these could lead to operational risk. So recently, if you observe, there is a 14,000 crore fraud done within Punjab National Bank, right? By one Mr. Modi, NM Modi. So again, it was a classic case of a bank letter of credit being abused and a loan taken to the tune of letter of credit taken to the tune of 14,000 crores, which is a classic case of operational risk because there was a failure, clear failure of risk and controls, right? So, and the list is endless. There could be many other risks also. So, just an exhaustive list in this. So, who are the stakeholders? What does the framework tell us? So, if you observe the left-hand side, you can see there are different divisions. So, you can see the language as first line of defense, second line of defense. First line of defense is typically the business divisions themselves. Second line of defense is basically the control functions. So you can see there is a risk control function, there is a compliance function, there is a finance function. Now, and the third line of defense is the internal audit, group internal audit. And if you observe, the group internal audit is sitting above the group executive board and directly reporting to the board of directors. They are not reporting to the CEO, which is to maintain that independence so that they are not influenced. And that is one of the biggest points which the regulators always say, that the risk control functions are, they need to maintain their independence so that to avoid any conflict of interest, and they should ideally be not in the revenue generating functions. So in that sense, there is a great job satisfaction also that you are actually trying to contribute to the overall health of the franchise, even though it is not necessarily revenue generating, but it could be revenue or loss saving, right? So you might ultimately you need to have a trading license, or you need to have the permission or the ability to run your own business. So in that sense, the risk management function can add a lot of value, because all the earlier losses that I spoke would have been avoided if adequate risk management processes were there in place. Now, towards the right hand side, so risk management is not only about also saying, hey, risk is there, what do I do? It's not about just complaining, it's not about just flagging the issue, but it is also about quantitatively asserting what is the issue and coming up with numbers or data points to prove, so that concrete actions can be taken. So, which is what in the towards the right, if you see, it is defined in the group wide risk appetite. For example, So there are specific objectives. So I want minimum capital to be this much. I want the earnings to be within the not to exceed a certain standard deviation of the average historical earnings. I want the leverage ratio to be this much. I want the liquidity to be at least for 30 days. And there are many which the banks have put in for that, right? Equally, solvency objectives, funding. I want to be funded at a certain time or within a period, right? And that kind of gets projected into risk capacity and gets converted into risk exposure through various statistical measures. It could be earnings at risk or capital at risk, all of the different measures. Right? So it is quite technical. While it starts with a qualitative assessment, it also needs to get into the quantitative aspect of it. Right? Now, while we spoke about the stakeholders, the landscape, what is also important is to understand specifically the 3-4 types of risks which are very widely focused on and where the banks have to keep capital aside. For example, there is a mandate to keep 8% minimum as the capital, because if you observe, the most fundamental problem or fundamental nature of the banks is that they are money rotators. They take money from depositors, right? From all of us. Let's say out of 100 rupees, generally of the assets that they hardly have 6 to 7 rupees of their own money on an average. So which means balance 95 or 94 rupees are taken from dollars, are taken from depositors or loans, like people like us. Then what do they do? That 94 rupees, out of that, maybe they'll keep, let's say, 10 rupees. The balance 84 rupees they give out as loans, or they get into risk-taking activities. Now, those loans, as long as they are doing well, the banks is basically, they are giving you lower interest rate and they are asking for higher interest rate. It's just like a money lender in the olden days. That's the glorified nature what the banks do. Now, if the loans go bad, or if that 84 rupees that they're putting to take more further risks of complex derivatives and they hit a big loss of 300 rupees or 500 rupees, they can't pay your 84 rupees that they have taken from all of us, right? So that's the fundamental nature of the bank, which is also in financial language called as leverage, which means they have 100 rupees, 6 rupees is only theirs, 94 rupees is from all of us. Now, if they put that money for gambling, in a sense, that's the problem we have, because tomorrow we will not get paid what our money was. So in that sense, these credit risks become important, and hence the regulator expect the banks to keep at least 8% as capital, which means if you are taking 100 rupees of risk, 8 rupees you please keep it aside, so that it will cover for any potential losses. The actual ratios that the banks are keeping these days are actually 15 rupees or something, like up to 15%, because they don't want to be, because the bank also loses its credibility, right? If you hear regularly that, oh, there is a problem with ICICI Bank, you will not go to that bank anymore, correct? So same logic. So within this risk, credit risk takes the biggest cake, because that's where most of the money, because banks are basically lenders, right? Lenders, and also they do over-the-counter derivative trades. So you can have credit risk by lending, like outrightly they gave me a loan, or they can also have counterparty risk, where they trade derivatives with other counterparties or other banks. In that, they could encounter counterparty risk, which is what they were supposed to get the money, they would not be getting. So in which case there is a loss. So credit risk is one which is pretty critical. Market risk refers to, as I mentioned, the risk of loss due to any change in the stocks, effects or rates. Operational risk, we spoke about the Punjab National Bank issue. Liquidity risk has also become important. So the Silicon Valley Bank, which recently collapsed, while the issue started with market risk, because they invested they invested a lot in the bonds, and the interest rates grew quite a lot. Usually the Fed Reserve rates are around, it was zero for quite a long time. It has become 4%. Because of that, there is approximately a 2 billion loss. But unfortunately, they did not have enough margin or funds. And in the meantime, because of that loss, there is a contagion effect of Suddenly the 84 rupees example I gave, let's say if it is 84 rupees is from 84 different people, the bank's guess is that maximum 5 people will come to us at any point in time. I can protect the money. What if all the 84 people come at the same time and ask you, hey, give me back my money, my deposits? Then essentially you gave a loan out there, but you don't have anything to pay because you already gave the loan to someone else. So that's when it collapsed. So liquidity risk also is important. So climate risk is the next thing which is coming up. So within credit risk, if you observe just an example, there are many different roles that the risk analyst does. So we could have a role in consumer credit risk modeling, small business credit risk analysis, which is all in the retail segment, corporate credit risk analysis. It takes a lot more judgment, so you can see a bigger scheme there. Country risk and structured finance analysis looks at structuring of particular loans to suit a customer's requirement. Financial institution credit analysis. So it's not that the banks are infallible. Now, no banks trust each other also. Hey, just because you're a big bank today, tomorrow you might not be there also. So Credit Suisse, for example, is being taken over by someone, I mean UBS, right? So Credit Suisse, as we know, is no longer will be there. So you never know when the next bank will go, which means when you are trading with other bank, which is also called as counterparty risk, counterparty, which means the other party might not pay you, is also risk, right? So all of these divisions have different skill sets, but all of them are basically in the credit risk management, and there are majority of the roles are in credit risk, and then you have operational risk roles, you have market risk roles, you could have liquidity risk roles. Now these days there is a latest topic which is coming up in climate risk, because the key aspect is about sustainability. There is a global requirement in India also. If you observe, there are a lot of goals to go net green by 2050, or net green, or by 2030 also we have certain targets. There is a national hydrogen policy that has been brought out by the government to encourage alternative fuels. India wants to go 100% renewable, or reduce the share of fossil fuels to minimal number between 2030 to 2050. So every government is actively doing that, right? And there is a lot of incentives and subsidies towards EVs. So that is part of the climate risk, which is basically the temperature related one, right? But it is an emerging field, and there are need for professionals in that field also, right? Physical transition, liability risk. Physical risk refers to actual floods, right? So last 3 days we had quite a lot of rain in my hometown, unreasonable, untimely rain, and obviously the whole shops were closed for 3 days, the trains were closed for 3 days, 2 days. So obviously it's a big risk. You know what is happening in the north, right? So there is also a lot of actual physical damage that is happening. Transition risk refers to, okay, you are moving without adequate planning. Liability risk refers to, okay, because of certain climate related issues, you face loss and people are suing you. That is the liability which you enter, right? So there is again an interesting aspect of how can the climate risks, if you observe this slide, the transition risk, physical risk, how can they create financial risks? Now that's an interesting study, which is, I'm just giving a high level overview, but that's quite interesting and exciting. So one example could be property damage or households. There is a loss of income, property damage. For example, if you have a loss of income or property damage, you might not be able to pay because you will default. You will do not have money, right? Or it could be collateral depreciation. Or market risk, the repricing of equities, fixed income. Repricing essentially means the stock price going down, for example, right? There's a massive flood or there's a massive climatic disaster because of which the Sensex tanked. So that could be another risk. Or liquidity risk would be because of these shocks, people want ready cash and they are not willing to deal with in long-term assets. So that's a very interesting study, and there is a lot of action that is happening in this sustainability and climate risk related initiative. So that's a new risk role, which is lot in demand these days. And one of the studies actually says that the GDP could decrease by 21%, 25%. The top right graph if no action is taken. So all of these kind of give a compelling reason for us to pursue this new avenues and understand how do we mitigate these new risks, right? So the last one which I wanted to share is, of course, the career progression within the risk management field could be quite rewarding. So the first, the left, career opportunities over the next 8 months. Of course, the general feeling that, okay, so this is taken from the survey of GAR, which is Global Association of Risk Professionals. They do a pretty good job so they are the eminent institute worldwide. There is PRMIA and others also, but I think GAR has quite a lot depth and breadth. So basically the opportunity seems to be increasing quite a lot. And if you look at the bottom one, would you recommend risk management as a career? So all the risk professionals are overwhelmingly recommending. Hopefully they are really genuinely satisfied, which seems to be the case, right? And what are the future skills? That is what essentially what we are also looking at. Top skills. Current career, of course. So climate risk, as I was just mentioning. So the top skills looks to be, climate risk, especially for future career, technology, leadership, interpersonal, technical. Of course, current also similar to be the case. But these are the skills that again, this is a survey across the board, global survey. So I've just picked it up from there. So high importance is as you can see given to all of this. So these top 5 could help. The next graph talks about in which the last bottom right one, in which of the divisions do they see roles. And I was talking about credit risk. You can see credit risk typically has probably highest number of roles because of the nature of the banking business in itself, right? But the roles typically that you can look at in risk management profession, it could be technology data risk management or a generalist, or it could be an operational risk, which talks about risk coming from failure of people, process, systems, and technology. Market risk, I was just talking about. If you're quantitatively interested, there's a lot of interest in that. Liquidity risk talks specifically about the asset liability management of division of a bank. Enterprise risk looks at a bit more 30,000 feet level in terms of, okay, what could be the strategic risk? Do I need to be in this industry? How is the industry changing? So a strategic risk could be more like, for example, OpenAI came up with ChatGPT, right? So Google did not have one. So Google immediately started Bard. So that's a fundamental strategic risk, which is, okay, they called it as code red. That, dude, I was just, Google is number one in many things, right? But still they could not come out with something like an OpenAI. Maybe because of their prioritization, or maybe because of their whatever it is, right? And so that's a very important strategic risk. And there could be energy commodities risk also. So commodities risk, we also saw tomato prices. I don't know in which part of India you are all on, but at least in the south, it was around 20-30 rupees, become 120 now per kilo. It's a big risk because of supply chain disruptions. Cyber security is absolutely coming up to be. It exists. There are many situations where the security of many big MNCs and companies were compromised also, right? So that continues to be a very big area. Climate risk, which we just spoke about, when audit functions obviously always exists, right? So these are the different roles that you could look at, and typically it's always good to have, of course, at a junior level, people start as an analyst, right? So you start as an analyst, put in a couple of years, right? Become an associate, then it could be an AVP, VP, or a director. So that is a typical flat hierarchy in banks. But different designations could differ in different areas. But you basically start as an analyst and then work your way up. But that would be more micro, which is more specific, right? then you could move along and get macro level skill set. But initial first 10 years, I think it's always important to be as technical as possible, and later the leadership kind of roles can come into picture, right? So if you observe, right? So initially the technical skills are extremely important. It could be quantitative, it could be technology wise also. So typically, you know, R or SaaS softwares, R or Python. Python is obviously ubiquitous. It helps everywhere, right? Certainly these softwares, these languages help to more in the, if you want to move into the technical side of things, as in the coding side of things, as in that the backend who creates those risk tools. But you could also be an analyst, or you could be a risk controller, who is basically the business user, or you could be the business analyst, right? But all of this, you should at least have one sort of technical skills and quantitative interest, because ultimately you need to be able to quantify why you think risk is high, why you think risk is low. It cannot be like, oh, I feel today's risk is high. That feeling will not work, right? And later, as you kind of have to communicate this to your colleagues or to the leadership, that is when the interpersonal skills and communication comes into picture, right? So usually that is the growth path, fairly technical. And again, as I just mentioned here, there are multiple different so people also who have PhDs usually get into model risk. People who are very quantitative get into market risk. People who want to have less quantitative can probably look at enterprise risk. But eventually, at least a fair understanding of quantitative techniques is certainly helpful, right? So with that, I'll probably take a pause for questions, friends. One last thing which I wanted to say is that when you are doing equity research on a stock, you look at what is the best that could happen, right? How best things could be. Like the stock is today 5 rupees, oh, when will it become 50, 500, something like that, right? But in risk, how bad things can get is what is the mindset that is required. So it needs a lot of detail orientation also, right? So, and I'm not saying pessimistic, but certainly a cautious mindset. So what could go wrong in this? What if this happens? What if that happens? Hypothetical. It's not necessarily that everything will happen. Yeah, but the idea is that we need to be prepared for that, right? So yeah, so I'll take a pause here, friends. So yeah, waiting for your questions. Nitish, anything else you want to add?
No, that's like lovely. I mean, it was like really a wonderful session. A lot of insights, and I mean, of course, when we take up the questions, few more points will come up.
Yeah.
But I'll give you a breather for like maybe 5 minutes while I take a little bit of
Sure.
time to actually, I mean, maybe also introduce the people about the work that we are also doing at IIQF, and then after that we'll take up the Q&A, all the questions.
Absolutely. So stay tuned, friends. So put all your questions as much as possible. Whatever I know, I'll try to share. Whatever I don't know, I'll try to find out, and Nitish will share it back. Yeah. Okay.
Yeah, absolutely. So before we go, I mean, please, as I mentioned earlier, also please feel free to type in your questions in the chat window, and in 5 minutes we will be taking up all the questions, and so allow us like maybe 5 minutes, and we'll take up the questions. Please feel free to, in the meantime, keep typing in.
Yeah,
we already have a lot of questions. Okay. Right, friends. So, I mean, as always, Ujjwal, it was like a lovely session, very insightful, and we will be, as I mentioned, we'll be going to the Q&A session where we'll be taking all the questions as well, one by one. And but in the meantime, I mean, I would also like to take this opportunity to, I mean, maybe introduce about ourselves and the lot of the work that we have been doing for almost like 1.5 decades in promoting the field of quantitative finance, financial engineering, and risk management in India. So many of you who have been regularly participating in our webinars and chats, so you all know about us. But still, to start, maybe briefly, let's introduce ourselves. Right, so I represent Indian Institute of Quantitative Finance, and we are a body which is we solely concentrate on education and training in the field of quantitative finance and financial engineering, risk management, quantitative algorithmic trading, and of course artificial intelligence and machine learning. We were founded by pioneers in India and top experts from the field of financial risk management, financial engineering, and investment banking. An educational institution, we focus on promoting education and training in the field of financial engineering and quantitative finance, risk management, investment banking, algorithmic trading, derivative products, pricing, artificial intelligence and machine learning, as I mentioned, and several other areas of modern finance. And for more than not only a decade, it's like almost half a decade now. A lot of you might not know, but we are the oldest quant body in India. And when we started, nowadays you all have a fair bit of understanding of what is quant, what is risk management, and again this fields are has gained a lot of popularity, right? But when we started out, even in the highest places of finance, this was very less understood. So this institute was primarily formed to promote this field of quantitative finance and financial engineering in India and risk management in India, right? So that is what we have been doing tirelessly for 15 years now, and of course we will continue to do more work going forward as well. So in our endeavor to actually build a solid workforce in the field of in all these fields, so we conduct very comprehensive certificate programs, which are all weekend online live lecture based courses, which are which can be done both by working professionals as well as students along with their job or any other full-time degree that they are pursuing, right? This they can do as an additional solid knowledge area which they can acquire by doing all these certificate courses, right? So so we have this course. I will start by introducing the oldest course that we have, which is being conducted since 2009. This is called a certificate program in quantitative finance and risk management. It's a 6 months course. It's a comprehensive course which deep dives into both theory and practical modeling for derivative valuation and risk management. Many of you who have joined this webinar, of course, a lot of you might already be working in this field, but there might be a lot of you who want to enter into this field, and this might be one of a good course to take if somebody wants to work in the field of risk management and quant finance. We have a course in the same domain called Certificate Program in Financial Engineering, but the financial engineering course is more mathematically deeper, and technically also we go a little bit more deeper into the programming aspects and all that. But that's a course, another course which is there, Certificate Program in Financial Engineering, a 7 months program, a comprehensive course which deep dive into both theory and practical modeling for derivative valuations and risk management again, but in a little more mathematical way compared to the CPQFRM course that I discussed earlier. Now, machine learning being one of the most ubiquitous field in all industry. Our field of finance, particularly, or derivative valuation, pricing, and the quant, the risk management, and algorithmic trading industry, as where like machine learning is used heavily. So we have a course which specifically teaches machine learning for finance. A course which is designed for teaching machine learning and data science in context of applications in finance, right? And so essentially, we have many courses offered by a lot of institutes in machine learning, but the thing is that there are not many offered which specifically target like areas in finance. Fintech or quant finance or derivative valuation, pricing, risk management, algorithmic trading applications of machine learning. So if somebody wants to learn machine learning in context of finance, this is definitely a course you can look at. And for those who are interested in algorithmic trading, which also is like a very hot area nowadays, So we have a couple of courses in algorithmic trading. One is a 6 months postgraduate program in algorithmic trading, a course which teaches all aspects of algorithmic trading using technical analysis, machine learning, and quant models. And for those who want to maybe get themselves introduced to algorithmic trading without going into too much of mathematics, they can look at a shorter course called Certificate Program in Algorithmic Trading, a course of 3 months where we teach end-to-end all aspects of algorithmic trading using technical analysis. Now, it has been a long journey, and in our journey, we have been fortunate to be associated with a lot of professionals who have done our courses, and I mean, many of them, not only professionals, even students, and they have utilized these courses to further their career or enter into the quant and the risk management industry, algorithmic trading, and all these areas. And many of them have shared their experiences and thoughts about how they have utilized this course and how they have found about the course. Not to advertise about yourself, but just to make you understand, I mean, if somebody is interested, then these are very comprehensive courses which one can use to enter into this kind of fields. So Abhijit is one of them. A few more people actually we have shown. I'm not going into detail. You can go to the testimonial page or in our website to look at all these wonderful thoughts that a lot of our students have shared. I mean, not to advertise, but again, for you to understand how these courses can be useful if somebody is interested in making a career in all these fields that we were talking about. Now, somebody coming from this kind of courses would be targeting companies to succeed as a financial consultant or a domain expert and lead quant teams of international banks, top hedge funds, and or Fortune 500 financial consulting firms. Companies like hedge funds like Renaissance Technologies, DSO, Citadel, Millennium Partners, investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, commercial banks like JP Morgan, Citibank, Nomura. I mean, even the Indian banks as well. I mean, ICICI, HDFC, for example, to name a few. Stock exchanges like NYSE, the New York Stock Exchange, our Stock Exchange, NSE. All these companies, corporates also do use quant and risk management. Consulting firms, yes, consulting firms nowadays they recruit very heavily into the risk areas, but they have the separate divisions for quant and risk advisory. So companies like EY, Deloitte, PwC, these guys have been hiring extremely heavily in the last few years. So that's like a good target area to look at. And yes, even the MNC IT companies like Accenture, Cognizant, TCS, and all, they also do a lot of work in the risk and the BFSI domain. So they also have a huge number of requirements in this area which you can target. So types of jobs in quant finance and risk management, you can be a quantitative research, you can go into quantitative research and analysis, you can be developing quantitative and analytical softwares, you can be building valuation models, you can go into model validations, you can be into portfolio, you can go into portfolio management, you can go into portfolio analytics, and yes, of course, you can target all the areas of risk management which Ujjwal was mentioning: market risk, credit risk, operational risk, liquidity risk, and going forward into climate risk and all other areas as well. In fact, our courses, we always keep abreast of all the latest developments. Like again, and Ujjwal was mentioning, climate risk is like a new area that has been a lot of work is happening in the recent times. So, I mean, we are also in the process of incorporating that in our curriculum. So we keep upgrading our curriculum to represent what is like the latest development in the industry. So our curriculum always prepares you for the jobs where you can come out and directly join into the desks. So you can be, apart from risk management, go into derivative structuring, quantitative trading, high frequency trading, algorithmic trading, derivative trading, so on and so forth, right? Yes, and as I said, it's been a long journey. I mean, we have been working almost with every banks and financial institutions. I mean, in the quant and the risk management domain, this is just like a small representative list for companies that we have worked with. I mean, it's virtually with all. I mean, who has who of the finance world, right? So IIQF has conducted more than 6 lakh man hours of training in financial engineering, quantitative finance, investment banking, risk analytics for large MNC and Indian financial institutions like BNY Mellon, Capgemini, Thomson Reuters, ING, Citibank, NSC, BSc, LSC, analytics companies like Globop, Society General, even Evaluser. So a lot of companies actually we have been regularly been their trainers. I mean, they have participated in our courses. We have been training their team, so we have been a trainer for, like, again, as I said, more than 1.5 decades. It's like we have been working on in this field. And yes, our endeavor, in our endeavor to promote this field, we have worked with the educational institutes as well to promote the field. We have conducted sessions and workshops, and like we have done courses for IIT Bombay, BITS Pilani, NITI, to name a few. Again, a lot of work, but this is just like a representative list. And yes, since to express our gratitude to all those who have taken their time out and joining us in the webinar. And if you really have an interest in making a career in quant and risk, in the certificate program in quantitative finance and risk management, the next batch is commencing from 26th August. And in the normal terms, the cash discounts that marketing team sometimes gives for early registrations and all that, of course, those periods are over. We are about to close the registration. But as like a special token of our appreciation for you joining, anybody wants to join this course by 7th of August, and if they have participated in this webinar, they can use the webinar code webinar0508 and avail a 25% waiver of the course fee. Anybody is interested, they can touch base with us. These are our contact details. You can get in touch with us. You can go to our website and fill up the inquiry form or the brochure request, or you can call us in this number 8976993622, or you can email us at info@iiqf.org. Anybody who gets interested, they can definitely take up. They can use this. As I mentioned, you can definitely join with like a waiver of 25% on the cash discount on the course fee, right? So with this, I will like to start the Q&A. If you are ready, Ujjwal, I will take the questions one by one. I will collate the questions, and I'll guide you on your. We'll take the questions one by one.
Absolutely, Ritesh.
All right, thank you. So let's go to the questions. We have a lot of them, and I will try to collate and regulate so that we take common questions together. And and if required, I hope like all of you would be okay like with extending for like 10-15 minutes, because I would like to take the questions as much as possible. Right, so I hope that is fine with all. Okay, so with that, I will first go to the question from Akash. So Akash is a credit analyst and he wants to upskill in it. The question is, what are the core technical skills that are needed for a career in risk management, and how do you approach machine learning? To what depth should we go? These are all his questions. So Ujjwal, would you like to take this up?
Yeah, absolutely. So thanks a lot, Akash. So of course you are already in credit risk, so I'm not sure whether it is retail or corporate, but certainly I think, as you could have seen, core skills which help is accounting certainly helps to analyze the balance sheet, number one. Number two, technically, I think analytical skills and these naturally go hand in hand, right? So there is no doubt about it. Machine learning is quite helpful for the simple reason that if you observe the typically the retail credit risk, or even in fact, even in corporate credit risk also, with the huge amount of data, there is a requirement for predictive credit modeling, not descriptive or reactive credit modeling, right? So to what extent, I would suggest probably, of course, there are many courses that are available. Certainly, a fair understanding of, there could be two options. One, you could be the model user or you could be the model builder. Model builder, obviously the technical requirement would be higher. For example, you probably, it's good to know how to code in Python. That is model builder. But model user certainly need to know what are the different variables which impact my credit model. To what extent my probability of default will be impacted, to whatever extent my loss given default will be impacting, to whatever extent my EAD is impacting, or what are the impact of the input variables on all of these parameters, which actually give rise to credit risk, right? So certainly,
Right.
an understanding of each of the parameters would be helpful, Akash. I hope that answers your question, at least to, yeah.
Yes, absolutely. I mean, very well answered. And just to add my 2 cents, so Akash, in terms of skills, as Ujjwal rightly mentioned, so yes, learning about the analytical side of the industry. I mean, as I mentioned when you asked the question, so you are, congrats, you are already part of the risk management industry. Now it is like a matter of going into more deeper credit risk modeling. And I mean, in current context, a lot of work, I mean, apart from like a very good skill in Excel, where a lot of work is done, but additionally, I mean, if you really want to go deep into the modeling, a lot of Python is used. So that's like an addition. I mean, it's a good skill to add as well. So yes, with that, actually, I mean, if you want to discuss in detail, I mean, you can call us. I mean, the number is shared. I mean, we can touch base with us, or we can, if you want, we can also touch base with you, and we can discuss one-on-one on how how to go about it, right? I mean, if you want to go more deeper. Now, going to the next question, Palavasa has asked, what are the tools that is required to work in the risk management industry? Whether we need to know any software tools. So to some extent, we have already answered that question, actually, Palavasa. So SNCHG, I mean, all the analytical softwares and tools, particularly, again, if you are really wanting to go deep into the modeling, in current context, Python is like a good tool to know as well. Now, Abhishek Vaishnav has asked. Yeah, please.
Just one quick addition. So friends, again, if you look at the, when you ask tools, friends, I believe you're talking about more from a technical point of view, right? So again, there are 3 kind of options that we have. One is the database related, where SQL will certainly help to pull out the data. But I think more and more focus is coming towards Python in order to aggregate and manipulate and transform the data, because Python usually is pretty fast. The third component is the additional reporting layer, where Power BI,
Yes.
you would have heard about low-code platforms like Alteryx and Tableau. So these certainly help in visualization. They are low-code, so you can actually customize your queries similar to Power BI. So 3 steps, right? Database, data manipulation, so database retrieval, data manipulation, data visualization. Those 3, in any combination of this, depending on how technical you want to become, certainly helps. Yeah, just wanted to add that point.
Very good point, actually. I mean, this is definitely a more comprehensive explanation. So thanks for that, actually.
Yeah.
So the next question is from Abhishek, who has asked, credit risk modeling is for the banking industry as a whole, or it's for sub branches for banks as well?
Okay, so credit risk modeling is a broad field, right? It is not only necessarily for banking industry. So yeah, it's for entire financial institutions industry. So technically, it could be bank, it could be asset management, it could be wealth management, it could be credit rating agencies. If you observe Fitch, Moody's, ICRA, CARE, CRISIL, all of them, they also do credit risk modeling. They actually provide the external credit ratings. Number 1. Number 2, the Basel 3 or 4, all of them required banks at a certain maturity level or at a certain asset level to have their own internal ratings, which is called as advanced internal rating based models. The idea is to have banks also a say in building up these models. So it's both the banks, financial institutions, and also the rating agencies which use credit risk modeling. Yeah, I hope that answers your question, sir.
Yes, absolutely.
Feel free if you have any follow-up question. Yeah.
Yeah, absolutely. I mean, please feel free to type in your follow-up questions. I mean, in case you want to add, I mean, ask anything more. But let's, in the meantime, going to the next question, which is from Akshita, and she has asked, what are the kind of job roles for risk management in the field of financial services? So we both have addressed this question during our preliminary discussion. So anything you want to add, Ujjwal, on this?
No, I think predominantly, yeah, we start as an analyst, and I mean, of course, you shared the long list just before this slide, right? If you would want to share that, yeah, I think it would be available in the recording anyway, right? So that is
Yes.
basically a comprehensive list of all the roles that we have usually. Yeah.
Sure. So then, like, going to the next question. So yes, Akshita, first thing is, like, again, as I mentioned, I hope you have got, like, again, your answer while we are discussing, I mean, during our presentation earlier. And anything more, I mean, you want to discuss, we would be happy to discuss in detail. You may connect with us and we can discuss in more detail one-on-one, right? Any further questions on this? Next question is from Vinod. Vinod has mentioned he works in a stress testing team of an MNC. What are the career prospects and professional areas for a non-quant person in risk management field? And what are the main functional requirements or attributes to excel in those areas? And from change management perspective, how is climate risk? Just a minute, this question is big, so essentially let me lay it out a little bit. And from change management perspective, how is climate risk getting integrated into policies and disclosures? So part of it, Ujjwal, I mean, you have already answered in detail. I mean, but I mean, first thing is, last point, of course, is like a specific question, and anything you want to add in terms of like the overall question, or do you want to repeat it? It's a big question.
No, it's okay. I think. See, thanks for that question. So first is quantitative. The more quantitative you are, the better it is. But it is there are many people who are in enterprise risk management or in business analysis functions, right? Where it's not always about Python and Excel. It is also about the qualitative aspect of economic analysis or the economic transmission channels that we need to create. That how is this, for example, someone does not do a mandatory training. I'm just giving a simple example because how could that lead to financial loss for the firm? In a most extreme example, you could end up by saying that, okay, someone did not do a training, because of that there was some incorrect data or incorrectly data sent to some external counterparties which they were not supposed to send, and because of that there was a loss, right? Or reputational or financial. So all of this analytical thinking certainly would help, number one. Number two, you had asked about the change management point of view. The change management teams or the business analysis teams are required to be able to appropriately understand what are the changes, what is changing, how is changing, who is changing, when is it changing. All of this requires the change management teams to be in the thick of the thin of these things. And the last point, climate and sustainability risk. There is a EBA, which is European Banking Association, and every other regulator also have this. There is a plan till 2025, wherein all the metrics at a more granular level of data is required to be reported. A simple example is, in Europe for sure, if you are giving a loan to a to house for mortgage, what is the carbon footprint of that house? Please also make a part of that in your appraisal. Or if you are giving a loan to an oil and gas industry, which is a heavy guzzler of fossil fuels, could you reduce that loan, or could you give it to more green loans, right? So this is the way, through reporting, this is getting integrated into the wider credit appraisal aspect. Yeah.
Absolutely.
I hope that answers.
Absolutely. Yeah. Thanks so much for that. Actually, it was very comprehensive and well explained. Next question is from Abhishek Vaishnav, and he says that how much time is needed for people from BCom background to understand the coding language, and what would be the difficulty level in this program? maybe like what this question actually, let me start by let me start answering, and then again I will request you to add if I miss anything, if you're okay with it.
Yeah, please. You are the right person for this.
Yeah, I mean, anyway, you have been like part of our faculty team for like 15 years, so almost since the inception. So I mean, you know as well, maybe more than me actually. But anyway, just to start with, I mean, Abhishek, yeah, if you are from a pure finance or a BCom background, and if you do not have a coding background, it's definitely a skill which takes time to learn. I mean, it is not like, again, it's a cakewalk, but fortunately for us, what has happened is like modern languages like Python, R, and all this are relatively easy to learn. I mean, that's why you'll see one of the reasons for the popularity of Python is that, again, it is relatively easy to learn compared to traditional languages like C++, Java, and VB, and all that, right? So, yeah, it's relatively easy to learn. Nonetheless, it would require work. I mean, there is no doubt about it. I mean, at the end of the day, it's a programming language. We do provide a lot of resources for you to learn the basics of programming, and Python is used very extensively in the course. So if you are referring to the Quantitative Finance and Risk Management course, on all the course, Python is used very extensively, including this. So, I mean, in terms of difficulty in this program, I mean, since the course teaches actual implementations as is done in the industry, right? So Python will be used very extensively, but if you follow the steps properly, if you go as we guide, and you do the required yards and hard work, you would be able to cope up. At the end of the day, this is like a course in finance. So a lot of people join from a pure finance background naturally, and finance people are not expected to know programming. Many of them are successfully have done the course, and they have successfully transitioned into more deeper risk analytics and even quantitative analytics profiles. So yes, I mean, definitely doable, but it will require work. Anything you'd like to add, Ujjwal?
No, absolutely, Ritesh. Absolutely. I think I've seen quite a lot of colleagues, irrespective of their first degree. It could be science, it could be commerce, right? Doing fairly quantitative roles, and vice versa also. Engineers also are doing accountant roles, right? So
Right.
so it certainly, I completely, I'm with you. My friend, it is basically the intent drives the content. So if you have the willingness to put in the effort, certainly it's not like a storybook, right? Technical skills are not like a storybook. So it does take probably 6 months to 1 year, depending on your pace. And as Nitish was mentioning, there is a very comprehensive content that is available. It's far too much, actually speaking. That, you know, if actually someone goes through all of them, probably they'll become the master of everything. so it has been put together. I saw that even in IIMs also, I have not seen that much of practical content from various different practitioners, right? That comes through. So it's not the lack of the material, but it's more of our intent and our efforts that actually decides. So I would say everything is out there for you. So 6 to 8 months usually, but absolutely is it's within control. Yeah.
Yeah. Just to add to that, see, 6 to 8 months is like for you to become like a decent level of expert, right? But again, as a start, I mean, even 2-3 months is good enough for you to have that basic understanding of the language, right? And then, of course, I mean, programming is a thing which improves with practice. So I mean, if you're
Practice,
talking
correct.
about doing the course, I mean, yeah, I mean, couple of months, 3 months is good enough to brush up on the basics, because the resources provided has been designed in a way which to fast track your learning. But yeah, I mean, that's like for an initiation, right? And then again, you would go through the course, you will learn the actual modeling in deep, and then again you download all the models, and again you practice, and then that's like takes time. That takes time. But again, to start with, 2-3 months is good to start, and then again you have to work hard after that also, right? So again, the next question going to Akash again. So he has asked like if we can highlight a little bit more on about model risk management.
Yeah.
I mean, what are the
So
that are required? Yeah.
So okay, now model risk management is also, there are specific roles in every bank. They fall within the wide aspect of the model committee or the quantitative desks. The idea is, naturally, every bank, there are hundreds of products that a bank actually does. At a personal, in the personal banking, it could be credit, right from the credit cards to the most complex credit derivative products in the investment banks. All of them use some sort of model. It could be the basic Excel sheet, or it could be much more complex Monte Carlo simulated model. The key is the model also might create a risk of valuation, which is your model threw up a price, like happened in Lehman Brothers, right? The biggest issue that happened was the popular model that was used to generate credit derivative prices, which used complex correlation technologies to bring out the prices. But that model fundamentally had some weaknesses, which people did not understand. So whatever the model throws up as an output, it's also important to validate that and check with the real world, right? So that's called as the validation process. There is enough backtesting or solid controls that the regulators have put in for everyone to go through. So that is point number one. So there are quite a lot of roles in model testing, model validation, model backtesting. Number two, naturally, model itself is quantitative in nature. So if you want to challenge how a model is built, then naturally, apart from the analytical skills, the quantitative skills that are required are a bit of the higher order than as compared to that of a model model user, right? Yeah. But it's a quite interesting role actually. Yeah.
Yeah, absolutely. So very well summarized again. And going to the next question, this is like definitely a good question actually. I mean, and might be of an important information to most of the participants. So this is again a question from Vaibhav, and he has asked, what's the difference between CCAR and DFAST? Would you
Very
like to take
good
that
question. Yeah.
Yes.
Very good question. So CCAR, okay. CCAR refers to comprehensive capital analysis and review. DFAST refers to Dodd-Frank Act stress testing. So DFAST is a subset of CCAR in a sense. So CCAR is, as the word suggests, it's a comprehensive capital analysis and review. It only not takes care of the quantitative aspect of how much money you have, but it also looks at the internal risk controls, assessments, gaps, escalation metrics, the entire framework. It talks about the process, basically. CCAR talks about the whole process, which every bank has to undertake. At a certain level, they have to undertake yearly, quarterly, number one. Number two, DFAST, is a component of CCAR. In a sense, okay, you said all the controls. So CCAR is talking about the high-level controls, assessments, internal assessment, ICAP, which is internal capital adequacy assessment. Good. But where is the quantitative metric? So that is where the Dodd-Frank Act stress testing comes with. In fact, in June 2023, also they released it is applicable for US, but sorry. Similarly, European Banking Association also has released their stress testing results recently. The idea is they take variables, macroeconomic or micro also, which is GDP, unemployment rate, growth rate, 10-year bond yield, 5-year bond yield, treasury rates, Sensex index, housing price index, volatility index, all of them are taken. They are shocked in terms of, like, they are adversely shocked to see, okay, what if the GDP goes below that level? What if the FX rate goes below this level? What if the unemployment rate increases? All of them, right? And then they look at what is the impact of that on the net revenue or all the typical financial ratios of the company. So yeah, so that's the difference.
Again, very well summarized actually. Thanks so much. Next question is from Devabroto, who want to build a career in credit risk modeling. Please guide me. So Devabroto, I think we have already taken up that question in a little different context, but again, overall, that question was already discussed in detail. I mean, the things that you need to do to make a career in risk management and credit risk modeling particularly. So again, a question from Vaibhav. I mean, he has asked, are sovereign models used for country risk or any other kind of models? I mean, is there a question we can discuss here?
Yeah, absolutely, Vaibhav. So the sovereign models are looked at when I say country risk models. They are used in both the banks and also the rating agencies to assess the rating of the country. Apart from that, for example, they are also important parameter in assessing the facility also, or the individual counterparty also. For example, a bank is giving a loan to a company situated in Sudan, for example, right? There is a geopolitical risk, there is a country risk, apart from the credit risk of that particular company who is seeking the loan or the derivative facilities. Now that comes with the political risk. So naturally, the country risk model also is an input into the credit risk model. Number one. Number two, countries are also dealing with each other, right? Sri Lanka is also taking loans from the US. Countries also take loans from each other. Now, if there is a sovereign guarantee of a particular country also, that needs to be assessed. So, in short, sovereign models predominantly are for country risk analysis used by both the rating agencies and the banks, but certainly where there is a bank exposure, it also is used to assess credit risk also, apart from country risk. Yeah. I hope that answers.
Yeah, that very well answers actually. Thanks so much for that. So, I mean, next question is again an interesting question. Please see if we can take this up. So, essentially, this is from Ashin, and he mentions, sir, then how is quantitative finance different from data science applied in risk management? Would you like to share your thoughts on this?
Interesting question. Now, see, at the end of the day, let me put it this way: AI existed. There has been AI race even in 1950s, right?
Absolutely.
It's not that today AI has come, right? The question is how does it how fast is it growing, right? Now, with the availability of the whole storage space and with the exponential availability of the semiconductors, that is, I hope I don't know if someone knows the Moore's law. Basically, the semiconductor, exponentially increases every 2 years or something like that. So essentially, the semiconductors and the transistors became smaller and smaller. The computing devices became smaller and smaller, because of which you can do lots quadrillion trillion kind of computations, because of which the AI is what it is today, right? Which did not exist as before, right? So it's all driven organically. So similarly, in one sense, it is the same. Now, quantitative finance specifically looks at utilizing quantitative techniques to mitigate financial risk. Now, data science, the specific focus is only on the data visualization, data mining aspect, not necessarily, it looks at always the integration of financial risk of the models. Right? The functional knowledge that is required for a quantitative finance professional is a lot more, because he needs to know both the coding and also the functional side of it. From a data science and risk management point of view, it is similar, but the data science requirement is a lot more than the functional requirement. For example, the person can just do a dashboard for you and say that, dude, you figure it out what the dashboard is telling you, whether the risk is high or not. But a financial risk person will have to understand both. So in a sense, they are pretty much interrelated and they use similar Python technologies. But I would say in data science, the focus is more on the data visualization and these aspects, and not necessarily the functional aspects. But I would probably consider to be the same. I would probably consider them to be pretty much similar, just a naming convention, right? And again, please understand where the word data science came from. Data science has come from the proliferation of mobile phones, smartphones, which give our inputs or our input data, purchasing data to all the e-commerce companies, all the Ubers, all the Netflixes, right? So that we are getting the customization that we want. And we feel good that, oh, today I get a YouTube algorithm recommendation. This is exactly the kind of music I like. So it is basically coming from the data that we only give. So that is the, it is not necessarily on financial risk, is what I'm trying to say. Does it help, sir? Yeah, hopefully it does.
Then
So
it definitely help. Actually, it's like a good summary of that thought. Thanks again for that. So moving to the next question. Okay. I want to be a credit risk modeler. This is from Akash again. Can you recommend me some books on it? I mean, would you like to recommend any particular book if somebody wants to go into credit risk modeling?
So there are multiple. I think Nitish, you can share that later with the team, right? There is a book by Gregory. Option Futures and Derivatives for sure is a classic book. That is, it also covers credit risk. Apart from that, it also gives very good foundation basis. Number one. Number two. There is a book on XVA by Gregory Peck or something. I will share that also link with yourself. So you can actually search for XVA, the new paradigm or something. So which also kind of talks not only credit risk, but also it talks about the whole credit valuation adjustment, debit valuation adjustment, which are basically the next topics in credit risk. Yeah. So both these things come to my mind when you start off. Yeah.
Yeah, sure. So there are, like, I mean, plenty of books, but again, yeah, these are two good books to start with. And yeah, I mean, there are a lot of good authors who have written like extensively on credit risk. I mean, maybe again, we'll separately share with you, Akash, collect and share separately some books. All right.
Yeah.
So next question is, yeah, I mean, it's from one of my favorite topic currently. How could we determine the climate risk? What could be the variables for it? So yeah, this is something hot, and I was expecting a question on this from somebody at least. So good. Lakshminder Panda has asked this. So would you like to answer this question, Ujjwal? How could we determine the climate risk, and what could be the variables in it?
Okay, simple answer. That is exactly why we have to do the climate risk course. So, but uh, but yeah, slightly longer answer. See, this is an emerging field, as I mentioned, our friends. So this is an emerging field, and that's, they are looking for people who actually can add to the library of the knowledge that exists. So right. So in fact, it is, I think, just the first SCR certification came in, which is by God, is 2021. 2020, I think, relatively just 2 years. But some of the factors for sure I can share. So it could be physical risks in terms of temperature, precipitation, right? Agriculture productivity, sea levels, which are some of the usual risks that we can think of, right? There is a global temperature limit or warming limit from the pre-industrial levels. The whole Paris Climate Agreement talks about keeping that within 1.5 degrees centigrade. Basically, the concern is that from the pre-industrial levels, the global temperatures have been rising. It has been warming, and it would be going up to 1.5 degrees more than pre-industrial levels, the average temperature, because of which the whole CO2 being trapped. Of course, that is what is giving the warmness of the climate, and because of this, the whole economic cycles or the climate cycles are going for a toss, because of which there is a damage to the physical infrastructure, unusual flooding or unusual. So unusual flooding happened in Pakistan. They lost a lot of money. It had a very big impact on their economy. Greece, for example, is right now going to a very serious heat wave up to 40 degrees Celsius, to the extent that at times the railway tracks are getting melted because they didn't probably plan for that, right? Similar situations happened in India also. So temperature, precipitation, agriculture productivity, sea levels, or the amount of heat waves, floods, cyclones, wildfires, all of them could be the typical parameters which influence climate risk. Yeah.
Yeah, absolutely. Right. So I hope that answers your question. Now, like again, we have already gone past our allocated time. So we'll take maybe 2-3 more questions, but again, we'll go through this very quickly because I mean, we'll wrap it up in the next 10 minutes. Right. So next question is like I'm from Vaibhav is asked. I'm also interested in knowing which kind of risk-related jobs out of credit, markets, operational, etc., have more opportunities in terms of statistical machine learning. Would you like to take that question?
Yeah. So see again, right? So to be honest, it is I don't want to be partial to any particular risk, right? All the three. Let me put it this way: the how analytical you want to get depends on yeah, to whatever extent you have, and all of the three have their own different uh, challenges. So market risk, for example, the data availability is very easy because FX prices, stock prices, commodity prices pretty much are available on the market, right? On the exchanges. The data analysis is easy, so you can try to say that yes, that is where statistical machine learning kind of helps because it's the predictability of the data.
Correct.
Credit risk, it's quite illiquid. We do not know when things will happen, and the data is slightly a bit of left skewed. So there also you could probably try to put more predictive models. Operational risk, the data is very difficult to get, much difficult than credit risk because you need to get the severity data for the last 20 years, and so there probably you need a lot more modeling, right? So machine learning, because you use the word Vaibhav, you mentioned machine learning. The machine learning works very well with some set of existing trainable data, correct? With some certainty, right? Then it can do on its own. So I would say market risk data is much more available, followed by credit and operational risk in that sense.
Yeah, absolutely. Absolutely. Again, very well summarized. Okay, now there's a question from Sampath, but again, Sampath, for paucity of time, I mean, this is something which is more at a personal level. So, I mean, we would definitely connect with you one-on-one and have a discussion on this. But very briefly, to answer your question, this IIQF certificate of quantitative finance and risk management, I mean, given your background that you work in derivatives operations, so if you want to go deeper, this is definitely more than sufficient. I mean, to get an entry, because this is like quite comprehensive in terms of both the theoretical aspects as well as the practical modeling. We will discuss more in detail with you. We will touch base with you. You can also connect with us, or we can touch base with you, and we'll discuss this aspect in more detail one-on-one. Hope that is okay with you. Nikhil, he has asked about to you, Ujjwal, if you can share where and what positions have you worked after MBA, and did you had any experience before? So, Nikhil, for paucity of time, this is something. I mean, with Ujjwal's permission, I can connect you to Ujjwal, and you can discuss his experience in detail and how his career track has been. Right. So if that helps you, we'll be happy actually. But that is something with at an individual level. With Ujjwal's permission, we will connect you to him directly.
Yeah, we can certainly connect.
Right.
Absolutely.
And
yeah, just to
right,
I was a chemical engineer. I was a chemical engineer from NIT Surat, so that's it.
Absolutely. So Vaibhav, we have taken up a lot of your questions, but this is something again for paucity of time. We would now maybe if you want, you can discuss it directly with Ujjwal, but we would be taking a couple of more other questions as we have taken up a few of your questions already. So his question is: are survival analysis models being used in firms for calculating credit risk as well? Would you like to take this now, or like would you like to take it later on, Ujjwal?
Yes, the answer is simple. Yes. Yeah. They are used, yeah, in certain pockets. They are used primarily in retail credit risk because that shows that is much more easier. Yeah.
All right, Akash, again, he has asked, how do I better understand credit risk models and how will I be able to make one? Again, not going deep into this, but yeah, one quick question, maybe in a little lighter note. Go through our course, Quantitative Finance and Risk Management, and you'll understand most things about risk to start with. Of course, you can study from a lot of books that are there, just joking. But yeah, I mean, definitely QFRM, not because it's our course, but it's definitely a very comprehensive course you can look at. Satyam has asked, how do I get into hedge funds? Does they require risk managers, and what's the whole process, as I am a FRM level 2 candidate? So would you like to answer that?
Yeah. See, again, sir, ultimately it's no, I do not know your full profile, but yes, hedge funds do require risk managers.
Yes.
Number one. Number two,
Absolutely.
there are quite a few in India also, but I think it's more on the middle office side, the captives that they have. So that could be the first entry point. Because of the segregation of responsibilities in front office and risk management, some risk management roles might not be available to everyone, but certainly they are available. And because you already are an FRM level 2 candidate, that certainly is a very good point. So I would suggest you reach
Absolutely.
out to people on LinkedIn. That certainly helps, sir. Yeah, with this positioning, basically. Yeah.
Right. Next question is from Manoj, and this is something also, I mean, we would like to discuss more in one-on-one, because to answer your question, we would actually have to understand your total background in more detail. So he asks, he is working in employee risk and wanted to move to credit risk. How can I move? Will this program help me? I am working in JP Morgan. Manoj, very briefly, this program is helpful to anybody who wants to enter into any area of risk. But overall, actually, I would wish to discuss this one-on-one with you over a call. And I mean, after I mean, discussing your overall background, it would be more easier for us to guide. So hope that I mean that is okay with you. Suhas has asked, I have 10 years of experience in custodian banking services. How do I shift my career domain to risk management? I just have some basic insights into financial risk. Ujjwal, quickly on that.
Yeah. See, again, there are many people who move from various roles, right? If I were you, if I was doing for 10 years in banking and custody, for example, in services, now if I want to move to financial risk, my first step would be to acquire some new learning and probably position myself, because at least in my CV searches, it would come that I have something related to risk in my CV, or either
Absolutely.
Naukri or LinkedIn. That is what I would approach it as. I would probably get an additional certification and then start positioning myself internally within the same firm or externally also. So that is what I would
Correct.
do, sir. Yeah.
Yeah, absolutely. I mean, similar question from Karthik. He says that he is currently in securities and asset servicing as a business analyst, but would want to make a switch to risk management, technology, or modeling. I do not
Absolutely.
have experience in risk. So, I mean, similar, same answer to you, Karthik, what Ujjwal mentioned. I mean, first acquire the skill sets, add those key highlights of the skill sets that you add in your resume, LinkedIn profile, and like again other areas, and then like place yourself and like start applying. Right.
Yeah.
So, one or two more questions.
So just one quick point, friends. I mean, for common aspect, right? See, I also did my FRM and CFA. That's how I, from an engineering background, I moved to a bank, right? So to position myself with
Right.
that, right? Then I
Absolutely.
learned again automation and then moved to automation. Now I want to learn climate risk. So ultimately, yeah, the positioning is helpful. Yeah. Yeah,
Right.
Nitish, the
Absolutely.
question.
Yeah, absolutely. So quickly to the next question from Vinod, and he has asked, is AI and ML coding heavy with chat? Can you, I think he was mentioning chat GPT, but again, with chat, can you can code in or R or Python, etc. What is model governance around deploying these techniques at front office risk and are risk control functions comfortable with it? So I'm assuming that he is mentioning about chat GPT and again using codes from there.
Okay, so there are two different points. Yes. So AIML certainly is coding heavy if you want to be the developer, right? Number one. Number two, for every automation, there is a formal risk governance process in every individual company, especially so in banks. Now, ChatGPT or these kind of softwares do not get deployed without a long list of, and approval process might take months also, long list of security clearances. So it doesn't get deployed just like that. So it needs issues regarding cloud to be sorted out. It requires issues regarding data privacy to be sorted out. So front office, I have not, there is no ChatGPT in front office systems as of now, and it is not relevant also for front office systems. Front office systems are there to house the risk. ChatGPT is much more helpful, to be honest, in contact centers or where there are, standard questions with standard answers, right? So just to clarify that, yeah. As of now.
Yeah, absolutely. Thanks for that explanation. It was again like, I mean, I think it was well explained. Now going to the next question actually. Abhishek, your question on like again FRM and other courses. So that is something we can discuss in like more detail one-on-one. But yeah, to summarize, FRM definitely is a good course to cover. It's like the most recognized course known, I mean, throughout the globe. But yeah, there are a lot of other courses which can be considered, and I mean, we will discuss that again on and on over a call if you're okay with it. Now going to quickly to the last two questions. Okay, Chandra has asked, what is the scope of corporate risk management in India and how should I prepare myself for this kind of roles?
So corporate risk management, I presume you are talking about a generic enterprise risk management role, sir. Okay, number one. Number two, because there is nothing like corporate risk management, right? There is either a like enterprise-wide risk management or financial risk management, information risk management, like that, so on and so forth, right? So for any risk management role, you have to start with one of these functions at a base level so that at least the tenets of the risk and the risk mindset and the risk and control approach is evident in your CV, basis which you can be fungibly be moving around different functions. So many people move. So a person in market risk can move to credit risk, vice versa. Operational risk can move to enterprise risk, vice versa. So that would be the approach I would probably take. Yeah. But again, having said that, if you are a completely new professional, then again having some additional same answer as before, having some additional skill sets certainly will help to position yourself. Yeah,
absolutely right. So I think this would be the last question that we would take up for the day before we wrap up the session, and this is from Sri Vaishnavi, and he has asked, apart from doing the risk oriented programs, what kind of thought process should one develop when working in risk domain? And are all roles in risk heavily dependent on technical and quant tools? So a lot of this you have taken up, but again, if you can just summarize, particularly on the thought process, because
it is a very good question actually, because
yes,
I think partly I answered one. So number one, so there was one friend of us who was called like Doc. So his name was Doctor. Basically, he used to analyze everything with a clinical precision, and his name was given like a doctor. Number one. So that clinical precision, number one, in terms of clinically looking at things without getting emotional. Number two is the due diligence to the minutest of the details, because the devil is always in the details, right? Number three is the mindset and the thought process is more of what if things go wrong. And this I mentioned before, in equity research, the whole idea is how much high the stock will go. In risk, the thinking process is how bad things can get. It can be anything, and how do I cover for that, right? So those are the three things which certainly are required in a risk role. Yeah. So because people will always say, hey, why are you so worried, man? It's okay, market will go up, don't worry. Why are you so bothered about this? Why don't you approve this credit risk loan? Don't be so pessimistic. All these comments used to come when I was in risk, right? I said, no, if I don't be pessimistic, if I don't think, then no one else in the bank will be thinking. For the simple reason that is our function's responsibility. So please, yeah, it is basically, it's not being pessimistic. It is about looking at everything, due diligence, clinical precision, minute details, and the thought process would be always about how bad things can get. Where are the risks? So it's like a time bomb, right? It's like a landmine. So there was one senior person who mentioned once saying that, hey, I don't know in this process how many landmines are there, when will they blast, where will they blast, and what could be the impact. So the landmines he was referring to the risks that are there in the processes. So that could be an example. The landmines example, probably, if you could remember. So yeah.
Yeah, again, very well summarized, actually. I hope that answers your question, Chandra. And okay, the last question is from Ashwin. I mean, other questions actually, but mostly we have discussed. So this is like a, maybe he has mentioned a couple of times. So let's like quickly discuss this. So his question is whether FRM is the most respectable qualification in risk management, and what is the position of CC Institute London in the risk qualifications. So FRM part, actually we have already mentioned, Ashwin, that again globally it's definitely the most recognized course in terms of the recognition per se. I mean, there are other courses as well. Ujjwal, would you like to give some idea about like the position of CC Institute London in risk management, risk qualifications?
I think there are many different certifications, but personally, I can tell, for me, I've been eating on the certification for the last 15 years. So all I can tell you is that, friends. So basically, and very in every bank I worked with, it was considered very valuable. So for example, when I was in financial control, talking to the trader that, hey dude, I did my FRM. So certainly at least put that credibility a bit higher, that, oh, this guy knows what he's talking, right? So I kind of leverage that certification quite heavily, and it's one of the most recognizable ones. So it's easy brownie points, to be honest. As much as compared to the other one that you mentioned, which I'm not aware of in the first place. I mean, I've not seen as much, but I could see the FRM generally whoever I speak to, it's quite reputed. Yeah. Personally, it helped me. All I can tell you is that personally, I owe my career to FRM in one sense. So and because it's it is quite a comprehensive course, especially in risk management, and quite widely recognized. So if you say the person has done FRM, oh wow, FRM kya? Okay, that kind of usual brownie points you get. Yeah, that much I can say. Yeah.
Yes, I mean, theoretically it's a good course, but again, just to add to that, I mean, another question is from Naresh, and he was like, what is the niche of IIQF compared to FRM CFA, and are there any tie-ups or exemptions? So no, Naresh, these are independent courses that we conduct. I mean, we don't go for any tie-ups and all. But yeah, I mean, the reason why people do our courses are compared to the other courses are that, again, in our courses, apart from the deep theory, the actual modeling is taught. So, I mean, if you really want to work in risk or even analytics, then again, only theory is half knowledge. So, yeah, I mean, if you know the actual modeling, then that really helps, because these are practical fields. So that's where actually is the major niche. But yes, I mean, I'd be happy to discuss one-on-one in more detail on how our courses are, like, again, can help you in like making a career in your field. I mean, particularly if you are wanting to enter into the quant or the risk and management industry, or in other areas of algorithmic trading. I mean, there are a lot of courses, but again, if you're talking about primarily risk and quant, then this quantitative finance and risk management, or the certificate program in financial engineering, these are courses which people have utilized very well to actually enter into this quant or risk analytics field. Or like if somebody is already working, there are a lot of professionals who are already working but have did this to actually get a more deeper insight into both the theory and modeling. So with that, I mean,
Just one quick
I'm
thing,
glad that, yes, please.
So just to add to that, right? I think FRM, the theoretical aspect, but as For me, luckily, because of the community that we have in IIQF, as Nitish was mentioning, over the last 15 years, I've kind of learned a lot from many of the interactions I had with many of the participants or the faculty, also myself, right? Apart from the theoretical foundation that I had, but all the practical modeling aspects, right? The Python models or the everything else, that is something which is a lot more than what you see anywhere else, because these are actually built, contributed by the community of the people that who's been there with with the institution for the last 15 years. So that is something that's it's personal learning for me also. All I can say is that it's a big personal on top of the theoretical knowledge which I had. But as Nitish was mentioning, right, it's about how do you do it, right? It's all about ready to use stuff also. How do we do that? So yeah, I just want to add to that, Nitish. Yeah, thank you.
Many thanks so much. Actually, I mean, we all have gained from each other, yeah, a lot. Actually,
Right.
I mean, that is, I mean, yeah, Naresh, to add to that, your networking opportunities that you're talking about. So, is briefly to answer that before we wrap up the session. So, Naresh was actually asking that question only. I mean, can you please talk about networking opportunities? Wonderful opportunities. I mean, the faculty members, they are all leaders from the industry, like usual. So all of them are actually top professionals from the quant and the risk analytics industry, particularly actually involved with hands-on modeling in international banks and other financial institutions with impeccable education backgrounds and all. And again, this, I mean, the student community also is like now alumni is like in the last 15 years. So many people have done our courses. So yes, if you have an interest in networking with the right-minded people in your batch, and I mean otherwise also, you can definitely interact and learn more, right? So yeah, I mean thanks Ujjwal for like that, a very insightful session, and I'm sure all the participants have gained a lot from today's session. And we have in fact actually extended the session by quite a lot, but again it was so engrossing that again we had to continue. There were so many questions. I mean, thanks for the participants also for all your patience and like all your interactions. I mean, there were so many questions, which shows the I mean the level of involvement you had with the session. I mean, it was so nice to see. Even actually it went I mean, extended the time by quite a bit. But I mean, you all were enthusiastic and you were still putting up your questions. And I mean, we tried to take up the questions as much as we can, right? And for some of you, I mean, as we mentioned, I mean, some questions are more of personal in nature. So I mean, for the interest of time and the interest of the large audience, we would connect with you one-on-one and we would discuss those with you. So with that, thanks once again, Ujjwal. Thanks everyone for joining in. I mean, please keep track of like our website, your mailers, our social media pages, because we keep on conducting this series of webinars as part of our series deep dives with IIQF experts, and we take up important topics regularly. We would be conducting many important topics in some of the more important areas, like climate risk being one. We would be having a session very soon on that as well. So I mean, we'll keep on continuing sessions on all the many more important topics. So keep track of us, and thanks once again. Have a great weekend. Enjoy the rest of the weekend. With that, we wrap up the session for the day. Thanks all of you.
Thanks, Nitish. Thank you, everyone. Have a great day. Thank you. Bye-bye.
Thank you. Bye-bye.